Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio, and today we're going to be talking about the one, the only, the biggest stock of 2022, and that is Smile Direct Club, ticker symbol SDC. So we're going to be talking about the business, who its customers are, the financial position, plugging it into our discounted cash flow model, and then we're going to be talking about why there's such exuberance surrounding this company. So without further ado, let's dive right into this. What are we looking at here today?
All right. So pretty much with this company, we're looking at a competitor to something, akin to Invisalign. Invisalign is owned by Align Technologies. Align Technologies is actually an investment that my sister has, by the way, and she's done absolutely insane with that investment. But Smile Direct Club is the dollar store equivalent, from what I understand, in terms of performance. And I'm talking about company performance, not the actual product, by the way, of this industry when compared to something like Align Technologies. So you're already thinking about getting not the leader in the industry, but somewhere way down the line. So Smile Direct Club kind of does it a little bit differently. They go direct to consumer. So basically, Austin, if you show me don't show me your teeth, but if your teeth are messed up, then you could contact Smile Direct Club. You could become a customer. You don't have to really go to your dentist. With Align Technologies, what they did is more of a partnership program. So if you go to your dentist or orthodontist, you can get your teeth scanned, right? And then they can give you the Invisalign, right? They can deliver that to you, or you'll pick it up from your orthodontist. And then the actual machines, Align Technologies owns themselves. All right, so this is not a video about Align Technologies. Let's focus on the king, Smile Direct Club. So this is one that there are, I'll say there's a large channel that has taken the time to tout this as a potentially great investment. And I saw other creators say that the reason why this individual believes it's a good investment is simply because people won't wear masks. Okay, if that person did say that, which there's no reason for me to disbelieve these people that he said that, then I don't know what to make of that. But okay. So let's continue forward with that assumption. I will then extrapolate that and maybe say it in a different way that maybe sounds a little more intelligent. And I will say that perhaps COVID or the pandemic basically might have hindered their overall business. All right, let's just keep it at that, right? That individual saying it's a masks thing is interesting. Anyway, so let's take a look first at the performance and what we'll see here. Austin, what do you think? How do you think this business has performed?
I think it's performed fantastically, Fabio. I think the stock has roared to all-time highs and has, beaten the odds. It's a real underdog story. This stock, sure it is. As you can clearly see, this trend we're seeing means one day it will be just a 100 bagger. It'll be beautiful.
Whatever. All right. Anyways, so so you've done great. Congratulations if you bought in at the IPO. You are up 88.7% since IPO. And since the bottom of January 29, 2021, you've made about 84%. Look at that. And if you bought it at the top over here, you made about 45%. Okay, some people are probably cringing really hard because I'm messing up the numbers. No, but in all seriousness, so this hasn't really performed well. But we have to separate the stock because there actually might be something really good under the hood. But as a performance, it hasn't really done well. I don't know much about this business aside from what they mainly do. I will be the first to say that as far as the nitty gritty details of what's to come, I'm not one to perhaps make a strong educated guess on that. Now we can see here, it is a very small business. It's now already a micro cap. So it's below $1 billion. So it's pretty small according to Google. And I mean, what it's clearly the little brother. It's like really small. Let me show everyone Align Technologies. And then just to show everyone, like, this is the big boy. So this is a $44 billion company. So again, they do much more than just simply the Invisalign. They kind of have a almost vertically integrated service in a partnership with orthodontists all around the world. But we're here looking at Smile Direct Club today. So if we go on their website, we kind of see they have a Why Invest tab, which I actually don't like to see this too much. It seems too sales pitchy. All right. So already when I see that, I think sales pitch, they're trying to, really on the website be a sales pitch, not just the investor presentation, but you can think of this as the investor presentation to some degree, but they're showing here all these people with fixed teeth. Wow, that guy's teeth went really white. Smile Direct Club, it causes your teeth to go really, really white. That guy has something going on back there. Anyways, a little bit videos about, our growth, very sales pitchy. All right. So that's pretty much all I have to say about this so far. Going to the model, let's actually hop into the model right now. And it's already not looking too good. The average growth rate, the reason why it's not showing this is because there isn't enough data to show the average growth rate of the past 5 years. Mm-hmm. So I think the average growth rate in revenue terms has been about 60%. So I had to bring that in manually. And let's say they continue that. I don't know. Let's say they keep doing that. All right. So if they keep doing that going forward, great. Now, I think the growth rate more recently has slowed down. So we can see here, massive growth right here. And then it bottomed out. And then now it's hopefully going to recover back to where it was. But none of this really matters in the scheme of cash flows because the cash flows have been negative all the way through. Austin, are you interested in this so far?
I'm kind of looking at it and I'm really trying to grapple and figure out why there seems to be such exuberance behind this company. Here,
this is really something I wanted to see. Yeah.
Yeah. I'm not entirely seeing, I'm not seeing it. I'm not seeing the story here. All right. But that's just me. I'm taking a look at some other things here. It's trading almost at book value. That might matter to some people in this instance here.
Yeah.
Those little things that they sell, you put in your mouth to straighten your teeth. It's a lot of inventory. Might be trading your book value.
I would say this is a highly speculative investment. I actually think on the nearer term, it may actually go up. But that's not a guarantee. Do not invest simply on that basis. But I do think that we may see some sort of bounce back, but on a technical basis, not really driven by the fundamentals per se on a cash flow basis. Simply put, if this company gets enough attention, right, then you could have some short-term swing, and that's not speaking to Wall Street bets specifically, but it's shorted enough that you could have a mini short squeeze, and it's such a small market cap. One thing that I am noticing here, and I'd have to do more research on this, but the model is telling me that there's probably dual classes. You see how there's a discrepancy, and I always have that to kind of do a smell test and tell me if there's two classes of stock showing up. And what it's telling me is that yes, there is. One thing I want to highlight to everyone, I want to check this over here, and they are actually utilizing a lot more debt as of late. So they are debt heavy. They have been diluting shareholders over the past couple of years. There is 1 year in particular that was actually very dilutive. And I think I can point it out right here, just on the years basis. It was in 2019, I believe. 2019 was the point of dilution, and that's pretty much because the company went public. So before anyone yells at me, that's my hypothesis. They went public and then they diluted a lot. But since then, they haven't been really diluting directly, right? We'd have to look at their debt structure, but they've been utilizing more debt than equity. And that may or may not be good. I mean, if you think the company's cheap, you really don't want them to use equity, but maybe they're pigeonholed into using debt and not equity because it's so cheap, or it's because it's not, quote unquote, overvalued. So that might not be good, because then the cost of capital is still decently high. So we have to ignore some of these numbers, because some of these numbers won't actually come out properly, because it is not profitable on a cash flow basis. And like Coker actually utilizes cash flows. So there's no way to actually evaluate this at the moment. So that being said, if we assume, for example, a 20% discount rate, we'd have to buy this pretty low. We'd have to see a 50% drop from here. And actually, let's remove those buybacks. I don't think they're going to be buying back shares anytime soon. They don't have the cash. So greater than 50% drop from here. And then we can just assume a 20% growth rate, and we could generate a 20% required rate of return. What are you thinking so far, Austin?
I'd like to actually see it now at potentially market average rate of return, because obviously anyone coming into this video would see 20%, be like, oh, you guys are crazy, you guys are greedy, without maybe understanding we like to apply a margin of safety to these sorts of things. I'd still like to see what market average, quote unquote, would have, which you've had your disagreements about what market average rate of return is before. So
yep, and we still haven't made that video. We'll end up never making that video, I guess. All right, so if I were to assume just these range of growth rates, the model is telling me based on the assumed risks, and I actually will say no, because I don't really know what will happen. I would put less than 1% of my portfolio. It's essentially a speculation. This is a speculative investment. There's so many things that we have to assume. And one of those being when it will be profitable, how much will it be profitable by? So let's take a look at the key ratios to kind of give us an idea of what's going on. So on a current ratios, like we got our liquidity ratios, it's okay. It's actually really good. No, it's not okay. It's really good. But we're taking a look here. This is where I was talking about. They went really debt heavy. So now their long-term debt ratio is at 81%. So they got a lot of debt on the balance sheet. Total debt ratio, not looking too good, but it's better than 2017, but it's gotten way worse from here. And what they probably did was they issued a lot of stock, and they probably cleaned up the balance sheet. That's my assumption of what's going on there. All right, gross profit margin, things have been getting better. So gross profit margin is actually up. We just want to see some scalability. And again, I may have come across at the beginning of this video as completely dismissive, but I always want to see if there's anything under the hood, like I said.
Yeah, and you typically change your opinions if the information provided to you warrants such change in opinions as well. So
yeah, so taking a look here, earnings quality. Okay, it's good, but remember that's not the end all be all. Sometimes it does not correlate. Okay, it correlates a lot of times that we've seen, but I don't, it's not something that we utilize as something to decide whether or not we're going to invest in something. All right, it's just another flagpole we use. So book value per share. All right, it's gone up and then it's going down right here. So cool. And then this is kind of important. So cash conversion cycle. Let's not trust the numbers too much over here, because this is when they went public, but sure, whatever. And then we see the pandemic really absolutely destroy them. So if your thesis is that they're going to recover from the pandemic stronger than ever, okay, maybe there's something to that. But it is an assumption at the end of the day. So based on this, 10% required rate of return, no assumption on dilution, which there probably will be dilution. And I think if I assume some dilution, it's a no-no. So let me see here. Let me change that to -2%. Yeah, so actually it's still okay. It's just even smaller position sizing based on the risks. Okay, so I don't think this company has a high probability of going bankrupt, but let's take a look. So no, and that's over the short term. Not really, but longer term that may change. And again, this is a negative cash flow company at the moment, so they are burning cash. So that actually might change quickly. Okay. Analysts have a sell rating with a price target on average at $4.13. They just probably haven't changed the price targets yet. And the stock has cratered as of late. So if we take a look in the past year, just over here in October, it was above that price target. And then it just absolutely collapsed about 60%. So if by chance you were a follower of that individual and you went into this company because that individual touted this business as something that I guess touting it as something that was amazing without really going over some of the risks. I hope that our video can kind of shed some light as to some of the potential problems with the valuation. I guarantee you that there are some more skeletons in that closet. God forbid this is a VIE. I don't think it is, but it could be. I think they definitely have multiple classes of stock.
Kind of curious. Yeah, now you piqued my curiosity. So
yeah, if it is one, then this will perpetually be cheap forever. I don't know why they issue them under those structures, because it's like they don't want to become rich, because the only way that their shares at the end of the day will command a premium is if they treat their shareholders fairly. Or it just could be dual class stock. That's the more likely option, I think.
Yeah.
If you really look into it. But yeah, small direct club, interesting idea. Okay. But it wouldn't be something that's for me. I wouldn't want to speculate my money into this. I would definitely require a massive margin of safety alongside some clarity as to when they're going to be profitable. Not just management's, guesses on when. I need to kind of be able to tell. So with that being said, Austin, you got any closing thoughts, or are you trying to find whether or not it's VIE?
I could not find, sadly, if it was a VIE or not.
That would be in the 10K if it was, but I'm leaning on dual class, which is, normal. The founder shares. All right.
Yeah.
Would you buy it?
No. And my thing, at least for me, like the message that I take away is I need to be exceptionally careful about which potential picks I hear from people online. And I need to always make sure that I do my due diligence when it comes to these sorts of things. Whereas instead of just blindly trusting someone because I like them or because I trust them, instead I do my own due diligence and then I arrive at my own decision about whether or not this investment works for me. So
fair enough.
What about you, Fabio? Do you have any closing thoughts before we wrap up the show here today?
No, I think that's it. I think we covered everything.
All right. Well, we are your hosts, Austin and Fabio. This is the Capital Mindset Show. We will see you guys later. Please be sure to share the video. It really helps out the channel. Like, comment, and subscribe. Visit our website at capitalmindset.org and also follow our social media links, our Instagram and Twitter at capital_mindset. And take care, guys.